Today, I cannot believe it. We are already in week 8. We are doing a damn thing. And I mean, this year is just flying on by. So, week 8 of our Wednesday webinar series for homeowners and home buyers, we have covered a wide range of things in the past 7 weeks. But last week specifically, we talked about what you need to know about getting approved. So now that you know what getting approved entails, we must make sure that you understand your full mortgage payment. I'm turning my phone down. I'm sorry. Last week, we talked about getting approved, protecting that approval. Tonight, we're going to take the next steps. We're going to talk about protecting your money, understanding your full payment, avoiding any financial surprises that tend to catch homeowners off guard, specifically if they're buying new construction, because smart buyers don't just focus on the price, they understand the numbers behind the payment. This is always a hot topic, okay? So understanding the real true cost of home ownership. So earnest money and protecting your funds, PITI, the PITI Payment Breakdown, the property tax rate impact, and why payments increase year 2 for new construction homes, and how to prevent those surprises are all of the things that we're going to cover today in tonight's webinar. And this is where many homeowners feel blindsided because the payment they were quoted isn't always the payment that they end up with. We see it if you scour any of the Facebook groups. You will see people saying, my payment changed, my payment recalculated, what happened? And that is in large part, 9 out of 10 is because they purchased new construction. And we'll explain why that happens. So I dropped some questions in the chat before. Questions that I kind of wanted you to ponder, see what your answers would be. And if you can locate the thumbs up button, or you can type a yes or no. But I want to ask, how many of you believe that your mortgage payment is just principal and interest? Greg, I don't know if you should answer. You're cheating. Okay. Has anyone heard, you know the answer. Has anyone heard of escrow but doesn't fully understand escrow? If you don't fully understand, that's okay. That's why you're here. We want to talk about it tonight. Now, did you know that property taxes can cause your payment to increase after year 1 for new construction? There's so many typos right there. And who wants to avoid financial surprises after closing? We should all have our hands up, right? All right, so those are just questions, things to make you go, things I want you to think about as we move forward. So, earnest money is a good faith deposit. It shows sellers that you are a serious buyer. It also protects the seller if the buyer defaults. And it is credited towards closing costs or down payment as you move forward in the transaction. Typical earnest money deposits on resales are going to be about 1%. On new construction, it ranges. Sometimes I see it $1, sometimes I see it $1,000, sometimes I see it as $2,500, sometimes I see it at $5,000, sometimes I see it as $10,000. It is going to largely depend on where that home is, that new construction home. This is I'm talking about for that. What phase that home is in is going to depend on how much the home is as well. So it kind of varies. I've had a lot of luck in getting some of the earnest money reduced if they want too much, okay? But it's typically 1%. Your earnest money is protected when you fall in line with all of the deadlines, right? So there's a financing contingency. They will tell you that you have to secure your financing and get your full approval by filling the blank. And there's a date there. And the reason why there's a date there is because things move fast in real estate, right? There may be a house. If we don't put a date there, it may be ready for you to move in 30 days. But if you're not working with your lender and responding to those emails and those phone calls, and in some cases, those texts that says, hey, we need you to get your pay stub in. We need you to get your bank statement in. If you're not responding in a timely manner, that transaction for that property can stretch on and on and on till the break of dawn. So they have to give you some deadlines, okay? Your earnest money is also protected when there's an appraisal contingency. Now, on government loans like FHA and VA, the property has to appraise for the sales price. That's your layer of protection. So the only time we really have to worry about the appraisal contingency is if it's a cash deal or conventional, right? And then your inspection option period. So you have a time built in the contract that tells you can get any and all inspections that you want. There's a certain amount of time. It's all negotiable. So I can't tell you 5, 7, 10 days because it really all depends on the contract. And so that's why when you're asking a real estate professional a question, in most cases, they'll say it depends. And that is because it does. So for your inspection option period, as long as you have those inspections done and you've gone back to the table to renegotiate what needed to be renegotiated, your earnest money is protected. So as long as you follow the contract timelines, your earnest money that you put down is protected. It is only at risk when the buyer defaults and plays outside those contingencies, plays outside those dates. Now, for us here at Beyond the Home Realty, what we do is anytime we put a buyer under contract, we do this with our buyers and our sellers. Anytime we put a buyer under contract, we take that whole contract and we pull out all those important dates so that you're just focusing on what you need to see, what dates you need to have what done. So we will give you a document similar to this that has all of the deadlines attached. And then what we also do is we take these dates and we put them and drop them on your calendar so you can see it on your smartphone, right? We use that to our advantage. And what that does, it takes 15, 20 minutes tops to do all of this, but it saves us so much time in the end and a whole bunch of headache and hassle. So we make sure that you have this information so you're not staring at a big contract like, oh my God, what did I just sign? You know those things that you need to do that have dates and deadlines attached. You know what those things are. And then we also throw in some do's and don'ts while you're under contract. Don't buy anything. Don't spend any money. Basically, that's what this is. But we send this out to all of our buyers when they're under contract. And for our sellers, we send this out as well. We are going to talk about the principal, interest, taxes, and insurance, which is what we call your PITI payment. This is what you pay every single month. Principal, interest, taxes, and insurance. You send it in one payment, okay? So it is your PITI payment. And lenders qualify you based on this full payment that encompasses these 4 categories: principal, interest, taxes, and insurance. Let's say we have a subject property and the sales price is $300,000, all right? Now, based on the interest that this buyer would have gotten, their principal and interest is $1,750. That's their P&I, that's their amount for their principal and interest. But hold on, there's more. The taxes on said property is $625 a month. They're paying $625 a month, right? The insurance is $150 a month. So that estimated payment is $2,525. All right, so I'm going to break it down even further. So we talk about the same $1,750 here. We're going to go here. This is how your loan servicer divvies up your monthly payment when they receive it. So I just kind of made it look a little cute. Let's say of that $2,525 payment, let's say you send your check in, it's $2,525. Of that $2,525 payment that you send in, that one check, right? They're going to take $1,750 of that, so $1,750, and that's going to go towards your principal and interest. Whoo! The lender saying, thank you for giving me my money back, all right? And then $625 of that is going to go into an escrow account for your taxes. And then $150 that's left is going to be for your insurance. So your lender escrows your taxes and insurance, meaning they collect a portion of each, the taxes and the insurance, every month, and they hold it in a dedicated account. when your annual tax and insurance bills come due, they go in these two accounts and they pay those bills. They come directly out of these two accounts. It's one account, but these two amounts come from that account, right? And they're going to pay them on your behalf. Now, you will still get a bill. It typically says do not pay this, right? You'll still get a bill showing you what your insurance is, but it's just because they have to make you aware of what you're being charged. So now, if there's no money left, right? Let's say your taxes came in a little bit more. It's going to create a shortage. So you're going to have to pay either in a lump sum, you're going to have to pay that money back to your lender, or they'll break it up over some months and you can pay it back that way. But then that is going to, like I said, create a shortage if you don't have enough money. If by chance you do have money left, they're going to refund that money to you. If there's money left over, meaning the taxes came in a little bit less, they're going to send you a refund. I will tell you to take that refund and I will tell you to put it in the bank and send it back to them if you can, and tell them to apply it towards the principal or set it in an account for later on, but just have it for the house. I encourage you, do not spend that, because you'll find out here in a little bit why I'm telling you that. Again, the service provider, they're going to hold your taxes and insurance until the bill comes due, and they're going to pay that on your behalf. If it's not enough money, there's a shortage. If there's money left, you're going to get a refund. Okay. All right. Now, what is a property tax rate? Because we just talked about taxes right here. So what is a property tax rate? A property tax rate is the percentage charged by local authorities. It funds schools, helps maintain roadways, provides emergency services and infrastructure for the area. The formula for the property tax rate is your home's value multiplied by the tax rate divided by 12. That is what you are paying every month for your taxes. They're going to divide that by 12, and that is what goes in this column of PITI. Okay. All right. So we're going to have a real example. You can get your phones for this if you want. I'm going to grab mine. So we're going to do a little math since we have our smartphones. Okay. The tax rate impact. Let's do this example. Let's say you have a home. Where's my other cat? Let's say you have a home that's $300,000. Just talking about that same $300,000 property. If it's in an area that has a 2.3% tax rate, 3% tax rate, or 3.5% tax rate, you see how this impacts your monthly payment. Because remember, you're paying principal, interest, taxes, and insurance. So on a 2.3% property tax rate on a $300,000 home, with the math that the math formula using that we just did. So 300,000 multiplied by 2.3 divided by 12 equals $575 a month. So you would, in this column, insert that amount right here where that 625 is. Does that make sense? Am I losing y'all? Am I going too fast? Okay. All right. So let's take the same $300,000 home. Let's go to a different part of town. So let's say you take that same home and you move it closer to, you find it closer in Houston, but the tax rate is 3.6. So now instead of paying $575 a month for property taxes, you're paying $900 in property taxes. So it's the same home, but a different monthly payment. You can see how these property tax rates can change your overall PITI payment. True story. I once showed two homes that were priced nearly the same. One had a $2,300 payment and the other one was a $2,650 monthly payment. The difference wasn't the house though. The difference was the tax rate. Okay. And so that's why we shop by payment, not just by price. That's why when I'm talking to Greg, he's telling me, okay, this is what Miss Shirley can afford, right? So I have to take that amount and I have to, have a conversation with Shirley to get her to understand, depending on what the approval amount is, we can get more bang for our buck if we move to an area that has a lower property tax rate as opposed to going to an area that has a 3.5% property tax rate. Okay. So we have to understand that. Do we have any questions so far? Okay. All right. Perfect. Okay. So we understand the PITI and how the tax rate can impact your payment, right? Okay, let's move on. Now, so when we are, again, watching social media, I'm telling you, at least 4 times a year, you're going to see someone post, my payment went up. What happened? And somebody's going to post, well, did you have a fixed rate? And they'll go, yeah, I thought my interest rate was fixed. It has nothing to do with that, because 9 times out of 10, you probably did have a fixed rate. The reason why your payments can change, I'm telling you, 10 out of 10, this happens for new construction homes. In most cases, when you go into a new home community and they tell you, oh yeah, with our preferred lender, we're going to do this. We're going to give you 15,000. We're going to pay, this for you. We're going to give you washer, dryer, blinds, refrigerator. They're going to do all of this. Well, the thing about it is, at least in my experience, and Greg, you can chime in on this. In my experience, they don't show you the full payment. They don't tell you what your full payment is. I'll explain full payment in just a second. They only tell you what your payment is going to be based on the unimproved lot. Okay. So what I mean by that is unimproved is just for the land, just the lot. Improved is the house and now sitting on the land. So if we go back to PITI, your payment on the principal and interest could be what would we say, 1750. Well, your taxes could be, let's do the math. Let's say you have a $60,000 lot, put in a $300,000 house on a lot valued at $60,000, and it's appraised at that value by the county. The county always assesses that. All right, so 60,000, and we said, what I say, a 2.5% property tax rate. So 2.5% is 60,000 times 2.5% equals $1,500 for the year, right? So this is what someone would pay taxes on if that land stayed unimproved. We're going to divide that by 12, and that'll tell us what it is per month. So it's $125 a month. Now, so this will be someone moving into this new construction home that had a sales price of $300,000. They're going to pay on their principal and interest for the home $1,750 plus $125 plus $150. Okay, so $1,750 plus $150. So that's going to give them $2,025 using this example that I'm saying now. All right. So now let's say the following year, they've been in the house for a year. The following year, you still have this lot that's $60,000 based on what the county has appraised it for. But now they're saying, I see this $300,000 home. So now you put a $300,000 home on it, and now it's $360,000. So now we're going to say $360,000 multiplied by property tax rate. I believe we use 2.5, and that's $9,000 for the year. They're going to divide that by 12, and that gives us $750. So you see the difference? It was $125 before with just the unimproved, but now that it's improved, it went from $125 to $750. And that is a difference of $625. Their payment is going to go up by at least $625. We'll discuss in a minute why it's going to be a little bit more. Okay, so that is what that is. So it's a huge tax adjustment. $625 is huge, a huge adjustment for anybody. I don't care what your pockets look like. It's a huge adjustment. So your payment can change again because the tax is reassessed. The county reevaluates your home's value annually, If it goes up, your taxes go up, and so does your payment. Your payment can also change due to insurance. If your homeowner's insurance premium increases at renewal, your escrow payment adjusts to match. True story. I just got an email from Goosehead. Last year, the insurance on this property was $6,000. Okay, this is a personal story. I got an email that said, "Baby, you still owe us $925." Like, damn, the insurance went up by $925. Yes. So that is going to, in this case, it won't apply in terms of the payment going up because I pay my own taxes and insurance on this property. But if someone had that escrowed, it is going to recalculate the payment. At the end of the day, it's still more money out of my pocket. So the insurance went up and I got to send them almost $1,000 extra because that's what it changed by. And then so now I'm saying it's time to shop my homeowner's insurance to get that lowered, see if I can get that lowered. All right. So then also your payment can change due to an escrow shortage adjustment. So we just said with the example that we used that because you're now taxed on improved property versus the first year of a new construction home, you were taxed on unimproved. You have to make that up, but you also have to make up for the shortage because there's a shortage. When we went back to the piggy bank, I said if they don't have enough money there, there's going to be a shortage. Okay. So you have to divide that up. You can make a lump sum payment or you can divvy it up by a couple months. And that's a conversation that you'll have to have with the mortgage company at the time. The reason why I like my buyers to not only talk to the new construction lender, their preferred lender, but an outside lender as well, is because sometimes you may not always get all of the incentives from a builder that they provide if you use their in-house lender, but I guarantee you this, you're going to know what your full payment is going to be, right? So another true story, I had a client, I told her, I said, okay, so they're telling you that your payment is going to be $1,900 a month. In reality, your payment is going to be like $2,400 a month, right? And I told her, I explained to her the difference between unimproved versus improved. Well, I don't know what happened. I told her, I said, take that extra $400 or $500, put it in a savings account and don't touch it because they're going to call for that money to be due when they realize, okay, she wasn't paying enough in taxes. And so true enough, they called for that money to be due. She didn't have it. So we had to end up selling her home. So that's why it was a new home. This happens. We see this more and more in cases of new construction homes. All right. So you want to make sure that if you are looking at new construction homes, that, okay, you could talk to their little old preferred lender, but get you a good, reputable outside lender as well so you can compare those numbers. Because again, they're going to hit you with $15,000 or $10,000. We'll give this to you, but it's tied to our lender. Well, if you have someone like Greg on your side, he can look at what they're charging you because 9 times out of 10, they're charging you more in pricing for doing the loan. And Greg, you want to chime in on that? Can you hear me?
Yeah, I was muted. Sorry.
Okay.
Yeah.
That's okay.
I mean, yeah, they do. They're playing with the money, right? So they'll say they're giving you 10 or 15,000, but they're charging you a lot of fees, and sometimes they may even claim they're buying down your rate, but it's maybe higher than the market rate to begin with. There's a lot of things like that, and then they're notoriously bad for quoting really low on the taxes a lot of times now, even on the insurance, they want you to use somebody with their insurance group. And yeah, you may have a really low premium, but you probably don't have very good coverage, and you probably have a
Right.
really high deductible, maybe even up to 5%. And that's dangerous, right? So if you buy a $300,000 home, a 5% deductible is $15,000. That means you're responsible for the first $15,000 worth of damage before the insurance company is going to cover anything.
Yep.
So, and then yeah, you end up with escrow shortages when they base the payment off 60 or 50 or $70,000 land value, and generally don't educate people or warn you that the payment's going to go way up next year. So,
Mm-hmm. So you have to make sure that you have a team in place that knows their and that you trust. When you have a builder that has their own mortgage company, their own insurance company, their own everything. I'm not telling you that's not good for you because they could still put out a quality product, right? You want to get another opinion about, are all these fees what I should really be paying? Because they show you shiny and brand new money, in your face, 10,000, 15,000, whatever. But a lot of their fees can eat that up, right? And then they will tell you we'll give you up to, in most cases. They may not give you the whole thing. We'll give you up to $10,000 in closing costs. Well, guess what? If you don't have a team that really is looking out for you, and let's say your closing costs come up to 8,000, they're not giving you that other 2,000 anywhere. You just don't get it. So you have to be really cautious. It can be done. People buy homes all the time, but you have to have a team that is going to support you and look out for you and have your back. All right. So, again, the new construction surprise. Year one, the taxes are based on the land only in most cases, which gives you a lower payment. And that is how they're able to qualify, these builders are able to qualify people because they're taking that into consideration, that lower payment. And then in year two, when the home is added, the taxes increase, the escrow adjusts, and the payment rises. So we already did the math on that. But here it is again, and I'll make sure that I put this in the handout that you're going to get, so you can kind of redo this on your own. All right. And most buyers always say, no one told me that my payment would change. So this is why I tell my clients before they buy, let's sit down and let's get to know your numbers. Let's bring a lender in. Another reason why I love outside lenders is they have more time for you. Those lenders that are the preferred lenders for the builders, they act like you gotta sit. Hey, can you put me on your calendar for a dinner date or a coffee? Like, no, I need to be able to get in touch with you. No, I know I can't just pick up the phone in most cases and call you because everybody's busy. I'm fine with jumping on your schedule, but I need to jump on your schedule in the next couple of days. We already talked about time is of the essence when we spoke earlier about the contingencies and whatnot. But most of the outside, they call them outside lenders, but most of them are able to have a conversation with you sooner rather than later. It's very difficult to sometimes get these preferred lenders on the phone to ask them any questions, and most of the time they want to communicate by email. And sometimes I'm old school, I need to get on the phone, I need to talk this out. I don't even really know the questions I want to ask you yet. I just want to talk to my lender, right? So very important to understand so you don't have sticker shock or tax shock. All right, so smart buyer strategy is going to be to ask about the tax rate before touring. If you have a realtor, they already know this. And this is why I tell people when they ask me, do I need a realtor to buy a new construction home? No, you don't need one, but you should want one because the builder, that rep that's sitting in the office represents the builder. The builder has their representation. You should have your own as well. So if you're working with a good realtor, they will already know what the tax rate is. You want to budget for year two increase in the payment. Okay. Make that a part of your strategy. You also want to shop your payment, not your price. So we talked about bringing in an outside lender, not just going with the numbers that the preferred lender gives us, and then keeping reserves for escrow adjustments. Because again, when there's a shortage, they're going to say, give me my money. Buyer better have my money. Okay. And they want that in a lump sum, or like I said, they'll break that up over some months for you. Now, key takeaways, things that we've discussed. Property taxes heavily impact your payment. your payment, the PITI payment, principal, interest, taxes, and insurance. And those two at the bottom, taxes and insurance, are the two components that cause your monthly payment to rise. Okay. In new construction, the payments often increase. Again, I'm going to say 9 out of 10, they will increase. Your earnest money protects your offer and your funds, and understanding your numbers prevents surprises. And as a homeowner, you want to be a healthy homeowner, a happy homeowner. You already got to worry about the sprinklers and how often you're watering your grass and things like that. You don't need to be worried about, oh, I went to my mailbox and my payment went up $800 and I wasn't expecting it. You will have already known, working with a good realtor and a good lender. My job isn't just to help you buy a house. My job is to make sure you can comfortably afford that home long after closing day, which is why we came up with Beyond the Home Realty, because we are with you beyond the transaction, beyond the closing table. So again, here's some questions that I put in the chat before you guys jumped on, that I wanted you to think about. Now that you understand your numbers and how to protect your money, next week, we're going to shift from preparation to positioning. And we'll talk about how to find the right home, how to write competitive offers, how to negotiate with confidence and win in today's market. Because even though we're in a soft market, okay, and in most areas here in the suburbs, it is a buyer's market. You still want to win. You still want to win. Because getting approved is step one, but winning the home is where strategy begins. So here is my contact information where you can contact me. If you think you're ready or you're wanting to find out if you're ready, please give me a call, text me, email me. You can scan right here to get in touch with me. And also, if you have a home that you need to sell and you'd like to find out how much that home could sell for, there is a QR code where you can get an instant valuation on your home. Now, this is where we're opening it up for questions. But before I do that, Greg, did you have anything to add to this?
Well, it's not huge, and it's not part of the payment, but keep in mind for the debt to income ratio that we're qualifying people on our end, we also break down the Homeowners Association annual dues like it was a monthly payment, and we add that in. Now, I don't ever show that because that's not part of your payment, but you are responsible for it. And so it does factor into the debt to income ratio.
Okay. So let's just say, for the sake of easy math, if you were moving into a community where the HOA payment was $1,200 a year, that is $100 a month broken down. You factor that into it, right?
Correct.
Into the debt. Okay.
So,
And then
and
also,
it's not bad to maybe set that aside every month, unless you're somebody who has quite a bit of savings, then you don't have to worry about it. But if you just bought a house, you may not have a lot left in savings. So you might want to think about that and set that aside because, at the end of the year, you're going to get hit with it and you can't
a
make
big bill.
payments on it. And if you pay it late, they start adding on fees.
Yes. And so
So,
I remember when I was a single parent and I lived in a community that was in a HOA, um, they would allow me to make a payment every month. So I took my annual HOA fee and I divided it by 12 and I paid it a little bit every month so that by the time December rolled around, I was on my last payment. I don't know if they do that now. I don't live in an HOA community. So I don't know if they do that now, but it's a question to ask the HOA. I know they change management companies, but it is a good question to ask if that is your something you want to explore.
yeah, so that was all I really had.
All right. Does anyone else have any questions from today, from the weeks prior? Anything else? See, make sure I'm not missing anything in the chat. No, ma'am. No, ma'am. No, ma'am. No, ma'am. Okay. Hello, AJ. Okay. All right. Okay. So y'all don't have any other questions? I cannot wait for next week. Listen, because we're doing this every Wednesday, I don't know if that in my mind is being calculated as this year is flying by. Is you think that's a part of it, or is the year just really flying by? Because I think in a week or two we're getting ready to spring forward, and I feel like we just fell back with the time change. Miss Patricia, do you have any questions?
No, not at this time.
Okay. All right. So after you finish that guide, you may have questions, and that's fine. You can always send them in. We can answer them before, or you can always jump on my calendar and we can get something scheduled. But go through that guide. You're gonna have a lot of questions because there's a lot of information. So Greg, one of the things that I gave to had a I did the land guide, and that land guide has been such a hit. Like everybody is like really asking a lot of questions about it because I mean, land is such a different beast from residential. So I sent that. I think I posted it, and I've been sending it to people that are interested in purchasing land, and oh my goodness, overwhelming response. In this guide, we go over everything, questions before purchasing land, because everybody's like, oh, I want land, until they realize everything and they're like, I might have to think about it. We talked about in this guide common mistakes that buyers make, types of land you can purchase, how you can make the land work for you and have it become an income producing property. We talked about the different types of land. Um, yeah, we talked about all the tests, septic installation, water well installation, utility availability. We talked about it all in here, and this is 36 pages of goodness. We even talked about, obviously, financing land, right? Land is it's going to require more down payment than a home unless you're a veteran, right? Um, and so yeah, so we talked about all that. So that's been a pretty big hit. But yes, if there are no more questions, y'all know I don't like to just keep blabbing on and waste your time. I know everybody has stuff to do. We're right in the middle of the week. I hope you guys are having a fantastic week. But if that is it, if no one else has any questions, I just want to remind you that I am Daphne Brown, your broker owner of Beyond the Home Realty and your home girl, and I am always ready and willing to enable you to find your way home. Bye.